Hello everyone. Today we are going to talk about domestic and international dimensions of monetary policy. So, are you all excited to know more about this topic? In this chapter, we have several learning objectives. To identify the key factors that influence the quantity of money that the people desire to hold, to describe how the Federal Reserve's monetary policy actions influence the market interest rates, to evaluate how the expansionary and contractionary monetary policy actions affect the equilibrium real GDP and the price level in the short run, to understand the equation of exchange and its importance in the quantity theory of money and prices. Last but not the least, to explain how the Federal Reserve have implemented the credit policy since 2008. So let's start talking about money. Our fifth learning objective is to explain how the Federal Reserve have implemented the credit policy since 2008. Here you can see the figure relating to the relationship between the money supply growth rates and the rate of inflation. If you plot the rate of inflation and the rate of money growth for different countries, we come up with a scatter diagram, as you can see here, that reveals an obvious direct relationship. If you were to draw a line through average of the points in this figure, it would be upward sloping, showing that an increase in the rate of growth of money supply leads to increase in the rate of inflation. Now, I'll focus on the changes in the interest rate paid on reserves. In October 2008, Congress granted the Fed authority to pay interest on both required reserves and excess reserves of depository institutions. Initially, the Fed paid different rates of interest on required and excess reserves, but since 2009, the Fed has paid the same interest rate on both categories of reserve. The indirect effect is depicted in this figure as the interest rate based money transmission mechanism occurs because people have decided to purchase interest bearing assets with their excess money balances. This causes the price of such assets or bonds to go up, and because of the inverse relationship between the price of existing bonds and the interest rate in the economy falls. This lowers the rate, inducing people and businesses to spend more than they otherwise would have spent. So you can see here, a change in monetary policy leads to change in excess reserve. A multiple change in the money supply leads to change in the interest rate, change in investment, and a multiple change in the real GDP. Please pay your attention to this figure, that is adding monetary policy to aggregate demand and aggregate supply model. In panel A, as you can see here, a demand for money function, which is represented by MD, is given. It slopes downward to show at lower rate of interest, a larger quantity of money will be demanded. The money supply is given initially as MS. So, equilibrium rate of interest will be R1. At this rate of interest, we see from the plant investment schedule given in panel B that the quantity of plant investment demanded per year will be L1. After the shift in the money supply to MS, the resulting increase in the investment from L1 to L2 shifts the aggregate demand curve, and in panel C, outward from AD1 to AD2. Equilibrium moves from E1 to E2 at the real GDP of 18 trillion per year. Now let us turn to monetary policy transmission and credit policy at Fed. Fed can influence the interest rate only by actively entering the market for federal government securities. Now, one of the important concept is discount rate changes. The interest rate that the Federal Reserve charges for the reserves that it lends to depository institution is called as discount rate. It is the interest rate that the Fed charges bank that borrow from its discount window. Sometimes it is also called as a rediscount rate or bank rate. But banks rarely use the discount window because there is stigma attached to it. We know that Fed is considered to be the lender of last resort. Bank only uses the discount window when they cannot get any kind of loans from other commercial banks. Banks hold this viewpoint even though the discount rate is lower than the Fed's fund rate. So Fed's fund rate is actually the interest rate that bank charges from other banks for lending them the money from their reserve balances on an overnight basis. By law, banks must also maintain reserve which is equal to certain percentage of their deposits in an account at the Federal Reserve Bank. Fed lowers the discount rate when it decreases the Fed funds rate. So there is federal fund market, a private market. Basically, all the banks are there in which banks can borrow reserves from one another, and they want to specifically get the borrowing on overnight basis. One more tool is changes in the reserve ratio. A change in the reserve ratio is seldom used, but it is very powerful. It is the percentage of reserves a bank is required to hold against its deposits. Depository institutions must hold reserves in the form of vault cash or deposits with the Federal Reserve banks. A decrease in the ratio will allow the bank to lend more, thereby increasing the supply of money. An increase in the ratio will have opposite effect. You can check this website to see the current reserve requirements. Here there are three definitions. Just pay your attention to each of it. First one is FOMC directive. It is a document that summarizes the Federal Open Market Committee's general policy strategy. So, FOMC means Federal Open Market Committee. It establishes near-term objectives for the federal funds rate and specifies the target ranges for money supply growth. The next concept is trading desk. It is an office at the Federal Reserve Bank of New York charged with implementing monetary policy strategies, which is developed by the FOMC. Third one is Taylor's rule. It is a suggested guideline for monetary policy, an equation that determines the Fed's interest rate target based on the estimated long-run real interest rate, deviation of the actual inflation rate from the Fed's objective, the gap between the actual GDP and a measure of potential GDP. Fed's credit policy. Federal Reserve policy making involves direct lending to financial and non-financial firms. When many banking institutions were faced with possible bankruptcy during the 2008, when the economy was under financial crisis, Fed provided credit directly to them. The Fed's credit policy resulted in activities more closely resembling those of private bank than a central bank. The Fed has essentially paid banks a subsidy to keep hundreds of billions of dollars on deposit. These reserve deposit finance the Fed credit policy of extending loans to banks, non-financial companies, and the central banks. Let us see the two sides of the coin on the Fed's credit policy. There are three arguments in support of Federal Reserve's credit policy. First, it gives banks time to recover from the financial meltdown. It makes financial market and institution more liquid and solvent. Finally, it contributes to international financial liquidity. But again, critics of the Fed credit policy, they have offered three arguments against it. It provides an incentive for institutions to operate less efficiently. It also reduces incentives to screen and monitor in order to limit the asymmetric information problem. It makes monetary policy less effective. To conclude this chapter, let me say the few words that I have mentioned over here. While the Fed's mission of lender of last resort is still important, the Fed's role in managing the economy has expanded since its origin. Thank you very much for paying attention to the lecture. Please feel free to post any questions, anything that you do not understand from this chapter, anything for which you need more clarification. Just drop me an email or message me on Canvas discussion board. Even you can use the Google Doc that I have shared with you. Learning is very important, and I'm here to help you to learn. Thank you very much.